Welcome back to the Deep Dive. We're here to cut through the noise and get you, well, truly well informed. Today, we're circling back to a big name in Malaysian finance, Allianz Malaysia Berhad. We're going to be unpacking their latest results.
Yes, specifically, we'll be digging into their Q2 fiscal year 25 performance and the first half overall. Think of this as a follow-up, building on our previous conversations about them, our mission. To pull out the key insights from their reports, see how they stack up against the past and maybe some benchmarks, and figure out what it all means for them going forward. And we've got the source material right here, their official Q1 and Q2 results, plus analyst reports from MEF, RHB, and some coverage from The Star. All pretty fresh from late August 2025.
Okay, let's jump right in. The big picture Allianz Malaysia Group performance for Q2 and the first half, what are the headlines telling us?
Well, the headline numbers are pretty strong. Looking at the group, Allianz Malaysia pulled in a net profit of RM 213 million for the second quarter.
RM 214 million. How does that compare?
That's up a very healthy 28% compared to the same quarter last year, Q2 FY24. Although, interestingly, it was flat compared to the previous quarter, Q1 FY25.
Okay, so strong yearly growth, but maybe some stabilization quarter on quarter. What about the first half overall?
For the first half, 1H FY25, the total net profit hit RM 427 million. And that marks a solid 20% increase compared to the first half of last year. So yeah, definitely a positive trend year over year.
Right, a 20% jump for the half year, 28% for the quarter year on year. That's significant profit growth. What was really pushing those numbers up?
A lot of it boils down to really robust insurance revenue growth. That was up 12% year over year, hitting RM 3.05 billion for the first half.
Then that came from?
It was pretty broad-based, actually. Good contributions from both the general insurance side and the life insurance side. But there's another interesting layer here. The insurance service results were actually higher than analysts expected.
Higher service results, how so?
Largely because their reinsurance expenses came in lower than anticipated. So they managed their own risk protection costs quite effectively.
Ah, okay, so cost management playing a key role there.
Exactly. And on top of that, we saw a nice rebound in their net investment income in Q2. That helped offset some, lumpy mark-to-market losses they'd seen back in Q1.
Got it. So for you listening, these initial numbers paint a picture of solid growth on the top line, more insurance being sold, but also, critically, some smart management underneath, especially with things like reinsurance costs. That's a big deal in this industry.
Absolutely. It's not just about getting bigger. It's about getting bigger profitably.
All right, let's dive deeper then. This is where it gets really interesting. Let's break down those two core engines. Allianz General Insurance, AG, and Allianz Life, ALIM. How did the general side fare?
AGC, the general insurance arm, really kept its momentum going. Strong performance continued. For the first half, their insurance revenue hit RM 1.7 billion. That's up 14% compared to last year.
14% growth. Where did that come from primarily?
Mostly from higher recognition in their motor and fire insurance businesses.
Right.
Those are the bread and butter for general insurers.
Makes sense. And their market position.
Still number one. They actually managed to nudge their market share up slightly in the domestic general insurance segment, went from 14.9% last quarter to 15.1% as of June 2025.
Holding on to that top spot and even gaining a little ground, impressive in a competitive market. What about profitability on that side?
That looked better too. They benefited from an improved claims experience. Fewer large claims perhaps, or better management of them. This helped ease their combined ratio. It dropped by 1.5 percentage points year over year, down to 87%.
Okay, combined ratio. Remind us quickly what that means.
Sure. Basically, it's a key measure for insurers. It compares the cost claims paid out plus operating expenses against the premiums they earn. A ratio below 100% means they're making an underwriting profit. So 87% is quite good and an improvement from before.
Lower is better. So 87% means for every ringgit in premium, they spent 87 cents on claims and expenses. Good underwriting discipline.
Exactly. It shows they're managing their risks well on the general side.
So AGC looks like a strong story growth, market leadership, better profitability. What about the life insurance business, ALIM? How did they do?
ALIM also showed pretty encouraging growth. Their insurance revenue was up 11% year over year for the first half.
Okay, decent growth there too. Any specific drivers?
Yes, a really significant factor was a strategic move they made. They repriced a large block of their policies back in April 2025.
Repriced, so adjusted the premiums.
Essentially, yes. And this wasn't a minor tweak. It had a noticeable impact almost immediately. Their new business value generated in Q2 was RM 171 million. That figure saw a huge jump, 37% higher than Q2 last year, and 43% up from Q1 this year.
Wow, that's a substantial lift from repricing. What does that new business value tell us?
It's basically a measure of the expected profitability of the new policies they sold during the period. So a big jump means the new business they're writing is expected to be much more profitable. And this strategic move also helped boost their CSM, the contractual service margin.
Right, the CSM, that's the pot of expected future profits from existing policies, isn't it?
Precisely. And that balance grew 5% year over year to RM 3.6 billion. So it signals stronger expected future earnings from their current book of business.
So the repricing seems like a smart, albeit perhaps tough decision that's paying off in future profit potential.
It looks that way. And another positive sign for ALIM was very high persistency ratios.
Meaning customers are sticking around.
Exactly. Policyholders aren't lapsing or canceling their policies at high rates. Good customer retention.
That's crucial for long-term stability in life insurance. Any downsides on the life side?
Well, claims did normalize upwards a bit, which isn't entirely unexpected in the life and health space. But as we mentioned earlier, this was largely offset by that stronger net investment income they booked in Q2.
Okay, so a balancing act there. Understanding these individual segment strengths, it really shows where Allianz is finding success and, maybe more importantly, how they're adapting. That repricing move in life insurance, for instance, that feels quite proactive.
I agree. It suggests they're not just reacting to market pressures, but actively trying to shape their portfolio for better profitability, especially in the face of challenges like healthcare cost inflation.
Right. Let's talk more about those broader factors. We see the strong numbers, but what are the wider trends, the potential headwinds, or maybe overhangs, as analysts sometimes call them, that Allianz is dealing with?
Sure. On the positive side, a key trend was the really strong growth in GWP and AMP across both segments.
GWP, gross written premium, so total premiums collected. And ANP, annualized new premiums, a measure of new sales, mainly for life insurance.
Correct. Both indicators were very robust, showing strong sales momentum. As we said, AGS is pushing hard on market share, and ALIM seems to be getting a handle on the big issue of healthcare inflation. Their co-pay programs seem to be gaining traction, which is encouraging. Having customers share a small part of the cost can help manage utilization.
That's a key strategy many insurers are trying. Good to see. It might be working for them.
Yeah, and looking ahead, some forecasts even suggest ALIM could see strong investment income again in Q3 because of how the markets have been moving. That could provide another tailwind.
Okay, those are the positives. But it can't all be smooth sailing. What are the major headwinds or challenges?
Definitely challenges remain. Healthcare inflation is still a big one. It's a persistent overhang for the entire sector, impacting claims costs, especially on the life and health side.
Always a concern. What else?
For AGIN, the general insurance side, the second half of the year, particularly Q4, could be a bit trickier.
Why is that?
The monsoon season. Historically, that means more weather-related claims, floods, storm damage, things like that. That usually pushes up claims costs and could also mean higher reinsurance expenses for them.
Right, the predictable unpredictability of the weather, a seasonal challenge.
And RHB research specifically flagged what they call the unfavorable regulatory landscape in the domestic life insurance industry. That's a bit more nebulous, but it's something analysts are clearly watching. Could mean potential rule changes or stricter oversight.
So, managing costs, seasonal risks, and keeping an eye on the regulators. A complex picture.
It really is.
And on top of all that, there's still that ongoing legal situation involving the Malaysia Competition Commission, MyCC, right? Can you give us a quick update there?
Yes, that's still in the background. You'll recall ADC, along with some other general insurers, faced a proposed fine from MyCC related to alleged agreements on trade discounts offered to agents.
I remember that. Where does it stand now?
Well, AGC successfully appealed MyCC's initial decision at the Competition Appeal Tribunal, the CIT, back in September 2022. The CIT set aside the decision and the penalty.
So a win for AGC at that stage.
Yes, but MyCC didn't let it rest. They applied for a judicial review at the High Court. The High Court dismissed MyCC's application for leave, basically permission to proceed in January 2024.
Another step in AGC's favor.
Seemed like it, but MyCC then appealed that dismissal to the Court of Appeal. The hearing for that appeal was initially set for May 2025, but got adjourned. There was case management on May 29th to fix a new hearing date.
So the short version is, It's still ongoing. The legal wheels are still turning.
Exactly. It's a process that hasn't reached a final conclusion yet. It represents a sort of contingent risk that's still out there.
Right. It just shows you the complex world these big insurers operate in. You've got market growth, cost pressures, regulatory changes, and then these long-running legal things, too. It's a constant balancing act.
Couldn't have said it better myself.
Okay, so given this mixed, strong results, but also these challenges and the legal uncertainty, how are the market analysts weighing it all up? What's their view on Allianz Malaysia's outlook? Sounds like there might be some different takes.
There are indeed, which is always interesting. You get different perspectives on the same set of facts. Take mid-DF research. They're quite bullish. They maintain their BUY recommendation and actually raise their target price to RM23.1. That implies, by their calculation, a potential total return of nearly 35%.
A BUY rating and a significant price target increase. Why are they so optimistic?
They describe the earnings as strong and much better than expected. They highlighted a few things. What they see is a cheap valuation pointing to the price-to-book value being 0.59 times, which is below its historical average.
Price to book, comparing the share price to the company's net asset value, a low PB can suggest undervaluation.
Correct. They also like the attractive dividend yield, around 5.6%, the aggressive market share gains we talked about, and what they see as encouraging progress on managing healthcare inflation. They were positive enough to actually increase their profit forecasts for the next few years.
Okay, so IDF sees value, yield growth, and good management. A pretty compelling bull case from them.
Yes, but not everyone is quite so enthusiastic.
Ah, okay. Who has a different view?
RHB Research, for example. They kept a neutral stance, basically a hold rating with an unchanged target price of MYR 19.6. That suggests about a 9% potential upside plus the dividend yield.
Neutral. Why the caution compared to MIDF?
They acknowledged the results broadly met their expectations, but they expressed a more cautious stance overall. They specifically mentioned wanting to see certain overhangs cleared before becoming more positive.
Like what?
They pointed directly at medical inflation as an ongoing concern, and also the potential for higher reinsurance costs for AG in the second half due to that monsoon season risk we discussed. So more focused on the potential headwinds.
Got it. A more wait-and-see approach from RHB. Any other analyst views?
TA Research, mentioned in the STARS coverage, also felt the first half results were broadly in line with expectations. They highlighted the improved combined ratio in the general segment and expect the life segment to remain resilient.
And their recommendation?
They kept their earnings estimates unchanged for now and put their rating and target price under review, saying they were waiting for more guidance from management. So sort of holding pattern there as well.
Interesting. So you have INDF saying BUY, RHB saying holdy, and TA Research pausing for more info. It really shows how analysts can weigh the same data differently based on their focus valuation versus near-term risks.
Precisely. It gives you, the listener, a more rounded picture rather than just one single opinion.
Definitely. Now, quickly, what about the ESG side? Environmental, social, governance, any updates there?
Yeah, a quick note on that. Allianz Malaysia reports they've cut their total emissions by 47% compared to their 2019 baseline. That's quite significant.
How are they achieving that?
One interesting point is they report zero Scope 2 emissions. Those are the indirect emissions from electricity they buy. They achieve this by purchasing renewable energy certificates, or RECs.
Okay, addressing their energy footprint. What about other emissions?
Their Scope 3 emissions, that's the broader category covering things like supply chains, business travel, employee commuting, did rise in 2024. However, they attribute this increase to expanding the scope of what they measure, specifically adding estimated emissions from employee commuting.
So they're tracking more, which makes the number go up rather than necessarily polluting more.
That seems to be the explanation. It actually suggests a deeper commitment to understanding their full impact, even if the headline number looks higher initially. For a company like Allianz, managing these climate-related aspects isn't just, nice to have. It's increasingly important for risk management and investor relations.
Right. So these varied analyst views, plus the ESG details, they really add layers to the story. It tells you that even with solid financials, the investment case involves looking at valuation, potential risks, and these longer-term sustainability factors.
Absolutely. It's never just about one quarter's profit number.
So let's try and synthesize all this. What's the main takeaway from this deep dive into Allianz Malaysia's recent performance? They've clearly had a strong first half of FY25. Robust results in Q2, driven by good revenue growth in both general and life insurance. Effective cost management, particularly reinsurance, played a role. And that strategic repricing in the life segment seems to be boosting future profit potential.
Agreed. Very solid operational performance. But, as we've discussed, they're operating in a complex environment.
Yeah, persistent challenges like healthcare inflation are still very much present. Potential headwinds from the monsoon season loom for the general side. And there's still that regulatory scrutiny and the ongoing MyCC legal case, adding layers of uncertainty.
It really highlights their resilience, though. Maintaining market leadership in ADX, generating that strong new business value in ALM despite the pressures that's noteworthy. And navigating that legal challenge requires a different kind of stamina.
It really does. It's a balancing act. So here's something to think about, a final thought perhaps. We see Allianz employing this dual strategy: aggressive growth in general insurance, trying to grab market share, while simultaneously making these strategic adaptations like repricing on the life side to navigate specific challenges like inflation.
A kind of offense and defense playing out across the two divisions.
Exactly. So what might this dual approach tell us about the future of the insurance business itself, especially in a rapidly changing economy? You've got evolving customer needs, shifting regulations, new risks emerging.
It's a crucial question. How do large, established players like Allianz balance aggressive expansion with the need for careful, sometimes difficult, strategic adjustments to maintain long-term profitability and value?
How might this specific balance they're striking now shape their path forward, delivering value not just to shareholders but to policyholders and other stakeholders too? Something for you to consider as you watch how this plays out. That brings us to the end of this deep dive. Thanks for joining us.